You know, when most people think about trading or investing, they look at one number above all else, the win rate. It's like a scoreboard, right? A higher number must mean you're better. But what if I told you that chasing that high score, that obsession with winning, could be the single biggest mistake you ever make? Let's get right into it, because this is one of the most dangerous myths in finance.
I mean, just think about that question for a second. It sounds crazy, doesn't it? A 98% win rate? That feels like printing money. It feels infallible. But the answer is, shockingly, a resounding yes. A strategy that is right 98 times out of 100 can absolutely, completely wipe you out. And we're about to break down exactly how that happens.
And this right here is the key mindset shift. It's not about how often you win. A truly robust strategy is one where you deeply understand how you lose. See, the amateur chases the thrill of being right. The professional, well, they obsess over managing the cost of being wrong.
So why are we so obsessed with this number? It's not about being smart or dumb, it's pure psychology. Our brains are literally wired to love the feeling of being correct, and that win rate, it feeds that desire perfectly. It creates this powerful and very convincing illusion of safety.
I mean, think about it. Every single win feels like you've cracked the code, like you've got a special skill. And of course, every trading platform out there shoves that number right in your face because it's so easy to sell. And on an emotional level, losing just feels bad, right? It feels like failure. So we naturally drift towards strategies that promise us we'll have to feel that sting less often, even if it's a trap.
All right, so let's pull back the curtain on that perfect-looking number. This is where the story gets really interesting, because the most important number in trading is almost never the one you see front and center. It's the one that's hiding in plain sight.
And there it is, 98%. I mean, look at that. It's beautiful. If someone offered you a strategy with this number, you'd probably bite their hand off to get it. It seems like the closest thing to a sure thing you could ever find.
But this is the question you have to ask. A single, flashy number is almost always hiding a much messier truth. And in this case, what's hiding behind that 98% is a total disaster waiting to happen.
And here it is. Here is the ugly reality behind that gorgeous 98% win rate. This is from a strategy that was literally designed to just close trades after a $1,000 profit. And look, it works. You see 125 small, steady wins. The track record looks amazing. But then you see that last line, trade number 126. It's still open, and it's sitting on a $64,000 unrealized loss.
And get this. This wasn't just a bad trade that lasted a few days. This single position, this massive loser, stayed open for 2 full years. 2 years! All that time, your capital is just bleeding out, tied up in one catastrophic mistake. And the craziest part, your official win rate still looks fantastic because that loss hasn't been closed out. It's the definition of picking up pennies in front of a steamroller.
You know, this isn't just some made-up scenario. This phenomenon has a name. It's called a Taleb distribution, named after the writer and statistician Nassim Nicholas Taleb. And it describes this exact profile, a long string of small, happy gains that are suddenly wiped out by one massive, rare, but devastating loss.
And honestly, there's no better way to describe it than this famous analogy. You're so focused on grabbing those little pennies, and it feels great. You feel productive, you feel smart, but you're completely blind to the steamroller that's rumbling right towards you. And when it hits, well, it doesn't matter how many pennies you picked up.
Okay, so if win rate is a trap, what's the alternative? How do we actually keep score in a way that matters? We need a better scorecard. We need something that captures the whole picture, and that thing is called expectancy. Simply put, expectancy answers the only question that really matters in the long run. If I make this bet 100 times or 1,000 times, will I come out ahead? It tells you, on average, how much you can expect to make or lose every single time you put on a trade. That's it. Is your strategy mathematically profitable or not? And the formula itself is actually pretty simple, but it's incredibly powerful. It forces you to look at the whole picture. It's not just about your win rate, it's about how your win rate interacts with your average win size and how your loss rate interacts with your average loss size. It's the complete equation.
Okay, this slide right here. This is the whole story in a nutshell. Look at strategy A on the left. An 80% win rate. Feels amazing, right? But your average win is tiny and your average loss is huge. The math doesn't lie. You're expected to lose 20 bucks every time you trade. Now look at strategy D, a 40% win rate. That feels awful. You're wrong more than you're right, but your wins are 3 times bigger than your losses, so you have a positive expectancy of $60 per trade. So which engine do you want powering your account?
And what this all boils down to is a really powerful idea. Your edge in the market doesn't come from being right all the time. Your edge comes from structuring your trades so that when you are right, you win big. And when you're wrong, you only lose a little. It's all about the shape of your outcomes.
And that idea is called asymmetry. That's the whole game. You're constantly hunting for opportunities where the potential upside is just way, way bigger than the potential downside. Think of it like this. Heads, I win $5. Tails, I lose $1. How many times would you want to flip that coin? As many as you can.
Nassim Taleb put it perfectly. He said, you need to stop asking, how likely is this to work, and start asking two different questions. If it works, how much do I make? And if it fails, how much do I lose? It's the magnitude of the outcome, not the probability, that truly drives long-term success.
So this all sounds great, right? But how do you actually do it? How do you put this into practice? Well, thankfully, there are some really powerful frameworks and mental models that can help us make these smarter, more asymmetric bets.
First, we have to understand our own brains. This curve is a fantastic illustration of something called expected utility theory. All it really shows is that the pain of losing $1,000 feels way worse than the pleasure of winning $1,000. That's why we're so scared of losses, and that fear is what pushes us into those deceptively safe, high win rate strategies. Just knowing this bias exists is the first step to overcoming it.
Okay, so once you've made peace with your own psychology, you need a system, a mathematical one. And that's where something like the Kelly criterion comes in. It's a formula that tells you what fraction of your capital you should risk on a given bet to maximize your growth over the long run. It's all about optimal position sizing.
What this does is it takes the guesswork and the emotion out of how much to risk. It gives you a mathematical foundation, and principles from it have been used by some of the world's best investors, like Warren Buffett. Now, quick warning, the full Kelly formula can be super aggressive. So in the real world, a lot of pros use what's called fractional Kelly. They'll bet maybe half or a quarter of what the formula suggests, just to reduce the volatility and build in a margin of safety.
So to wrap this up, let's just recap the 4 big traps that a high win rate hides. First, it can hide a terrible risk profile of small wins and one giant loss. Second, it tells you nothing about how that strategy will do when the market changes. Third, as we saw, the metric is super easy to manipulate and game. And finally, you can have 2 strategies with the exact same win rate, say 60%, but one is a path to riches and the other is a path to ruin.
And that's really what it all comes down to. The next time you look at a strategy or your own portfolio, I want you to completely flip the script. Stop asking, how often am I going to win? Instead, ask this, what's the absolute worst-case scenario? How badly can I possibly lose? Because if you can manage your downside, if you can make sure you survive your losses, the wins will eventually take care of themselves.